So I said to myself, are investors back in the market? Is the market going the right way? And really, really important for us on this show is, are investors back in the market?
The best we can go by is the ABS housing finance data. Yesterday, we got the update of this data for October, and it showed a pretty strong bounce back in housing lending across the board. But what's clear through the year to date is that investors have had the fastest rebound in the value of lending since it bottomed out in February this year.
And they are coming back in at an accelerating pace?
At a quicker pace. So if you compare that finance volume that was borrowed to purchase investment property in Feb to where it was in October, it's come up about 25%. And that compares to the owner-occupier segment coming up about 14%.
Right.
But the owner-occupier is very much still dominant in the market. In October, owner-occupiers accounted for about $17 billion in finance for new housing purchases, as opposed to about $9.5 billion for investors. So I guess when we think about the investor segment, it's smaller, but it's growing faster right now.
Okay. And what would you think is a healthy or a long-term average number for that ratio? If it's 17 to 9, what would it be like if investors were fully back in the way that we're used to?
Historically, investors comprise around 35% of new lending. And to be honest, they're a little bit higher than that at the moment, just because they've had a faster growth than the owner-occupier segment.
So I think we can say they are back in.
Yeah, for sure. And that ratio varies by states. So Victoria and New South Wales would obviously have a much higher portion. I think at New South Wales, it is trending at about 40% at the moment.
Right. Isn't that interesting? And also interestingly, if there's one city they think may not come to the party price-wise next year, it's Sydney, ironically, because if you think about some recent research from your rivals, one of your rivals, they had it as a negative. They had a negative figure on the Sydney market for the coming year. That is, they were saying it could range between -1% or flat. I think the theory there was that it had run ahead of itself or whatever. Do you guys kind of get granular like that?
Yeah, definitely. Let's not talk about our rivals. But
Let's
if we look
not.
at the CoreLogic data, we can see that the monthly pace of growth has already slowed across Sydney at a high level. So we had a 0.7% growth rate in dwelling values through October, which slowed to 0.3% this month. Affordability remains very stretched across the entirety of Sydney. But as you allude to, it's definitely the cheaper end of town that's doing better. If you look at some of the lowest value segments of the Sydney housing market, Lakemba, for example, other suburbs in Parramatta and the inner southwest, you're still seeing median dwelling values below $500,000 and relatively strong rental returns on those pockets as well. That's where we're seeing the stronger capital growth, and that's probably the segment that's going to be more resilient in a high interest rate environment.
That's interesting. So if you had a helicopter view and you were looking at the nation as such and you were an investor and you could go anywhere, things that might catch your eye like that, parts of Sydney that are still, linked to planet property prices. And Perth comes up regularly because the yields are so good over there, and the theory that has a lot of catching up to do. When you look ahead for the year ahead, and we'll assume that you're somewhere in that range, 3 to 5% for nationwide prices, is that where you are?
I think it's fair to say we will get some kind of low capital growth rate throughout the course of the year, but that's also assuming that interest rates trend lower in 2024 in the second half. But as you say, it is a highly diverse market. I think start of next year, we're going to see a lot more softness in overall Sydney and Melbourne dwelling market. Like I say, those cheaper pockets will be more resilient. But that also comes back to the fact that stock levels are pretty much back to normal in those cities. If you look at Brisbane, Adelaide, and Perth in particular, stock levels are still 40% lower than the historic 5-year average across Perth. And the growth rate across Perth continues to accelerate, 1.9% through November with no sign of slowing down. So I can't see that going negative at any time soon. It is critically undersupplied, and it makes our housing market highly diverse and much less easy to talk about as one single market.
I know it's it's an issue. Always has been an issue when you're covering property. Some notions are nationwide, if you know what I mean. So like we all pay the same interest rate, for instance. But we could have very different things going on in our regional property markets, which is something you could probably arbitrage. If you think about a parallel jurisdiction, like you could have another situation, you could have 4 or 5 countries near each other with 4 or 5 individual central banks, and those central banks would tweak the rates in those jurisdictions to be appropriate for the market. But we could have a situation where our rate settings are ideal for Sydney, but all wrong for Perth, or vice versa. So it's something I suppose investors think about and probably quite aware of, I imagine. Sophisticated investors certainly would be thinking along those lines.